Good morning. My name is Jennifer Ryan, and on behalf of the Alliance of Women in Workers' Compensation, I want to welcome you to today's webinar. This webinar closes out our Financial Acumen series. If you haven't had a chance to watch the previous 3 sessions, please be sure to go to our AWWC resource page where you'll find these sessions on demand. Today is titled Through the Lens, Evaluating Business Performance, will last approximately 1 hour and is a live interactive webinar being broadcasted today, Thursday, June 10th, 2021. Before we get started, I would like to thank our 2021 corporate sponsors for their support on hosting events such as this. They support us not because they want their logos up on a screen, but they support the cause, which is to affect positive change in the workers' compensation industry through networking, support, mentoring, and collaboration. The Alliance is inclusive of all professionals in workers' compensation, regardless of career stage, with the belief that we can all learn from and support each other. Please be sure to head to the AWWC website for all upcoming virtual events, along with 2 in-person events for 2021 at both the National Work Comp Conference in October and the WCI Conference in December. Our theme this year is Through the Lens, which will allow us to take different topics each month and focus on specific conversations that will bring value to our audiences. Today, Nicole Sauk, AWWC Board Member, will continue to host our Financial Acumen series along with 3 industry experts who you will gain insight from on this topic. Thank you for the time you are spending with us today, and we hope you enjoy this webinar.
Good morning, everyone. Thanks for joining us this morning. We are so very excited to be bringing you the 4th and final session in the Alliance of Women in Workers' Compensation's Financial Acumen series. I can't believe that we're already on the 4th. I feel like we started this 2 weeks ago, but it's been several months. I'm really excited to get to do this last one for you all. In this session, you'll hear from 3 of my colleagues, Stephanie Narvades, Antonella Sciortino, and Nicole Vargas. They'll walk you through the basics of the P&L, the balance sheet, and the cash flow statements. And we'll learn how each of these financial reports can help us better understand the health of our business. Before we dive in, though, let's do some quick intros. So I'll kick it off, although you just heard it. I'm Nicole Sauk. I'm the CFO at Ametros. I've worked in workers' compensation for about 12 years now, and I've been involved with the Alliance of Women in Workers' Comp for the last 2 years. I'll kick it over to you, Stephanie.
Hi, I'm Stephanie Narvades. I'm the CFO at Healthesystems, a pharmacy and ancillary benefit manager in Tampa, Florida. And I really appreciate Nicole including me in this last Financial Acumen series. I've worked at Healthesystems for 15 years as the CFO and 17 years total. So thank you.
Thanks, Stephanie. Antonella?
Hi, everyone. My name is Antonella Sciortino, and I am the controller at Ametros. I have been in the accounting industry for about 10 years now. I started out in public accounting, and that's where I received my license as a certified public accountant. I have been at Ametros since 2016, and I absolutely love it there. And I just wanted to take a second to thank the Alliance for Women in Workers' Compensation and Nicole Sauk for inviting me to speak today. I'm super excited to be here. Thanks.
Thanks, Antonella. And Nicole.
Hi, everyone. My name's Nicole Vargas, and I'm the CFO at Ringler Associates. I've actually been doing accounting for over, 25 years. I'm really excited to be here. I've been a part of the Alliance for a couple of years now, and the first actual presentation I went to was the one that Nicole and actually Stephanie presented at. So I'm really excited to be here and be a part of this. So thank you.
Awesome. Well, thank you all for joining me. All right, so we're going to get kicked off here. Before we do so, sorry, just technical difficulties here. I apologize. I've lost my screen. Bear with me. All right. Before we get started here, I'm going to give us a quick rundown of the items that we talked through in the first couple of sessions. So in the very first session, we learned about the budgeting process. So in this process, the financial and strategic goals for the company are decided upon. And then after that, the revenues and all of the expenditures needed to support those goals are determined. The output in the budgeting process is typically a P&L or a profit and loss statement, a balance sheet, and a cash flow statement. Then during the course of the year, these different budget reports are compared to the actual numbers so that the business can understand how they're performing towards their goals. And you'll hear all about these different reports as the panelists dive in and how they think through comparing to the budget as well. And then in the second session, we discussed project roadmaps and prioritizations. So this is where we utilize different strategies to help us determine the impact that the project will have on the business compared to the resources and the time needed to complete it. So this kind of plays hand in hand into the budgeting process, as these projects typically need to be considered in the budget to make sure that the business has the appropriate expenses set aside to accommodate the spend. This then led into our third session where we learned how to calculate ROI on these projects, so the return on investment. The calculation for ROI takes into consideration how much was invested into the project, which includes all of the costs of all the resources needed. And then it also takes into consideration the value that the project ultimately added. And in order to track your ROI, especially if it's for a new product line, it's really helpful to manage a mini version of the P&L. And this way you can see the revenues that were specifically generated by your product, the costs to service that product, and then all other non-service related costs, and then ultimately the earnings. And using these outputs, you'll easily be able to track where you are in terms of breaking even on your initial investment, and then how many multiples of that initial investment you'll hopefully ultimately make in revenue. So to get us started, I'm going to kick it over to Stephanie to talk us through the different components of the P&L and how it's used by businesses to understand performance.
All right, so you've probably all heard the term P&L. So the P&L stands for profit and loss statement, but there's a lot of other names that it can be called too. Some people say income statement, statement of earnings, statement of operations, financial results. So all of these mean the same thing, and they're basically your revenues, costs, and other expenses during a specified period of time. So, it's encompassing all of those costs for either, a month, a quarter, or a year. It can even be a week, but, normally it's a month, quarter, or year that's presented. So it's different from the balance sheet, which is coming up next, which is as a specific point in time showing the balance. This is showing accumulated transactions during the period. So you'll commonly see at the top of the income statement what year it's showing, for the year ended, and it'll show, December 31st, 2019. So these are the key components for the P&L. I wanted to give a summary slide so you all could refer to it if you'd wanted to. So I'll go through these real quick, and then we're going to take a deeper dive into some of them. So at the very top of the income statement, you'll have your revenues, which are the total amounts billed to your customers during that period for the goods and services that you've delivered. And then the cost of goods or services sold are the direct costs related to producing the goods or delivering the services. So you'll have the costs and revenues matched during that period. And once you've subtracted those out, you come down to gross profit. Gross profit is really showing your profitability for your core business. So once you have that, you'll subtract out your selling, general, and administrative costs, which we'll go into more detail. Those are all the operating expenses not included in the cost of goods or services sold. Once you've subtracted those out, you'll be down to operating income, or you might have heard this word, EBITDA. So your earnings before interest, taxes, depreciation, and amortization. And we'll talk a little bit more about that in an upcoming slide. Once you subtract all those, you get down to your bottom line, or your net income or loss. All right, so let's take a deeper dive into gross profit. This is a really important area to monitor for evaluating your business performance. Revenues, of course, are part of it, and they're more complicated than they would seem to be. Revenues have a lot of rules for revenue recognition. And, if there's a misstatement on financials, usually it's related to revenue. So revenues are recorded as you've delivered your goods or services to the customer and they've accepted those goods or services. So that's when you bill. So revenue doesn't have anything to do with cash changing hands. It's based on your billings. Now, there are some adjustments that can be made to revenue that need to be monitored. If you have a lot of returns, for example, and it's reducing, your gross profit because you have a lot of goods being returned, you may have a quality issue. If you're not collecting the cash on the amounts you've billed and you've exhausted all efforts, you might have some write-offs. So that's something for account management to monitor and for everyone to stay on top of. And then, not getting too far into the weeds, your auditors might suggest an adjustment to your revenue, a negative adjustment if you are having consistent trouble collecting on the amounts you bill.
Yeah, that's a really good point too, Stephanie, because we probably hear the term write-off all the time, and it's not like a magical thing where it just disappears. It is either an expense or a reduction in your revenue. So it's important to do our best to try to collect on those revenues to the extent that we can.
Right. Yeah. And, so your gross profit, after revenues, you subtract out your cost of sales. As I mentioned, those are your direct costs related to the revenues for that period. So you're matching those two together. And then you get down to your gross profit. And like Nicole just mentioned, so if you're having reductions in your gross profit, it could be related to write-offs or some quality issues of returned goods. So those are things that need to be monitored. Another metric you can use to evaluate gross profit is your gross margin percentage. So that's on the next slide, actually. But so your gross margin percentage is your gross profit divided by your revenues. So it's really a measurement of how much your revenues are exceeding your cost of goods or services sold. And the reason this is important is you can use gross margin percentage to compare yourself to other businesses in your industry to see if you have a normal gross margin percentage or if you need to improve. You can also use it to compare it to yourself in previous periods. If your gross margin percentage is declining, that's another area where you need to look into, are you not negotiating the best pricing for the goods you're purchasing, or maybe you're not charging enough to your customers, you didn't make an adjustment, or there might be other factors like we mentioned about the revenue that could impact gross profit and ultimately your gross margin percentage.
Yeah, and in a service-based industry, are your folks that are servicing that actual product, are they not working as efficient maybe as they were previously?
That's a very good point. So cost of sales, I should have mentioned this a previous slide, can include, the labor costs. So the payroll and benefits for employees that are directly involved, in producing the goods or services. And so if those costs are increasing because they're taking more time, there might be an inefficient process. That's a good point. All right, so as I mentioned, so that's the top portion, gross profit. You could have a really great gross profit, but if you're not managing your selling, general, and administrative costs, you could still end up with a net loss at the bottom. So this is also an important area. Some examples of SG&A costs are, your human resources, accounting, sales, marketing, account management, and IT. You also have some fixed costs, like most of us have rent. We have a lease that is fixed or it's escalating. There's really no way to reduce it if you're not doing well on your gross profit. You've got utilities, office supplies, software costs, travel. So all these different costs related to these areas are included here. So the key rule of thumb is they just cannot be assigned to a product. So you can't assign the payroll cost of this person directly to a product that's being delivered or a service.
Yeah, and that can get a little confusing because folks that are in sales are selling a product, but it's really everything that happens once that product has been sold that goes into the top part, everything to actually get that product sold. kind of goes into this bottom part here.
Yeah, and it could get confusing too with maybe customer service and account management, because they're like, well, I'm providing a service to the customer, but it might not be the core service that's being provided. So that it can get a little confusing there. But another way to look at it is that, you know, the cost of sales are variable with the revenue. So if it's, you know, you're going to increase your cost if you're increasing your revenue, and SG&A costs are not variable with the product or service being sold. All right, so once you subtracted the SG&A expense, you come down to this mysterious EBITDA, or operating income. So your earnings before interest, taxes, depreciation, and amortization. Auditors don't typically call this out on your financials. It's not a generally accepted accounting term. It was really developed by bankers and investors to help compare companies across, you know, industries and help to value companies. If you're, you know, companies being sold, they typically use EBITDA to value your company. And there's, you know, usually a multiple of EBITDA that's commonly used in your industry to value the business. But the main point of it is they wanted to leave out three things. They wanted to leave out any financing decisions, so your debt service or your interest cost, any accounting decisions related to depreciation and amortization, or even your capitalization policy, which we'll talk about in the balance sheet, and then any tax environments. You know, because if you're a corporation, you're going to have tax on your P&L. If you're a pass-through entity like we are, it doesn't show up there. So it's just eliminating those differences so you can provide a more even comparison across companies, if that makes sense.
Perfect.
So after EBITDA, you know, you do subtract out the net income, or the interest, taxes, depreciation, and amortization to arrive at net income, which is your very bottom line. So that's what they're referring to with bottom line. They'll say, you know, you're in the red if you're at a net loss, or you're in the black if you're doing well. So basically, if you wanted to back into EBITDA, one thing I forgot to mention, if you do have audited financials or financials for another business that you're looking at, you take your net income and add back all of these items. So you add back the taxes and interest and depreciation and amortization, and that would give you your EBITDA number. So kind of to wrap it all up, as I said, so the P&L is, you know, everything on the P&L is basically recorded on an accrual basis. Like I said, you know, revenues are recorded when we're billing. Your cost of sales, it doesn't necessarily mean you've actually exchanged cash. You may have been billed for that yourself. So I'm just kind of teeing that up because we will be talking about the cash flow statement later, which kind of reconciles the accrual method back to the cash method. But this example is a fictitious company. You can see it says for the period ended December 31st, it shows 2019 and 2020. I didn't include the budget on here, but commonly people do include their budget so they can compare what they've budgeted to their actual results and work on, you know, righting any wrongs there and adjusting their business if things aren't going to their budget. In this case, the company had a COVID hit. So for 2020, like all of us, they had a reduction in their revenues of about 20%, but you can see with their gross margin percentage remaining the same, they had pretty much the same cost structure. So it was really a hit on their revenues that caused their gross profits to decline. And then looking at their selling, general, and administrative expense, they do have some fixed costs that they couldn't do anything about. They've got their rent, their insurance, and maybe they have an advertising agreement where they pay for chunks of advertising. So those remain the same, but their travel went down and their office supplies, probably from not traveling for COVID. And then their consulting and salaries and benefits also decreased. because maybe they were seeing their revenues go down. They probably weren't meeting their budget numbers. So maybe they pulled back on some projects that they were going to hire consultants for and reduce that cost. And maybe they had to also right size some of their other salaries and benefits due to this reduction in volume and revenue.
Yeah, and I think an interesting thing here to note too is you did highlight that their gross profits went down, which makes sense because there was a hit to revenue, but the gross profit margins actually maintained the same year over year. It's one of those things where if your revenues are being reduced, there are your costs, especially if it's a good, you're not purchasing as much product to sell, or if it's a service, like you mentioned, there were some cuts that needed to be made, maybe in the SG&A area in terms of salaries, but that likely needed to happen as well in the cost of goods sold line as well.
Exactly. Yeah. And I mean, they reduced their SG&A expense, but it wasn't nearly enough to get back to a normal place. Right. Because they do need these folks. It's, keep the lights on people. They do have fixed expenses, like you really can't get out of your rent or your lease unless you are fortunate enough to sublease it if you're not in the space. So those are some factors. One thing I didn't include on here, but we look at when we're comparing our financials or looking at budget, is SG&A expense as a % of revenue. And we look at trending just to see if that's staying in line where we've been and where we've budgeted. So I'm a big percentage person. I like to look at everything as a % of revenue and just try to benchmark and track it. So you could see, their operating income or EBITDA was 5.5 million, went down to around $1 million. And then after their depreciation and interest, they're down to a net loss of, 1.35. So tough year, but they can use this information. They can use 2019 as a benchmark or normal year when they're planning for 21, 22 to try to see where they might be coming back and gaining back their revenues and what their related expenses should be.
Yeah, absolutely. And, 2020 was a really interesting year for everyone. And, as Stephanie mentioned, oftentimes these reports will have a side-by-side between, where you budgeted and then where you're actually coming out. So you can kind of analyze it, figure out where your variances are. With 2020 and with COVID, a lot of folks were forced to do a much earlier reforecast than I think they typically would. I know that we did. We reforecast almost every year just because you have a better understanding of where the year is actually panning out. But with the COVID year, it ended up being side by side of like, here's last year, here's our original budget, here's our COVID budget, and here's our actual numbers, so you can really see what the true impacts of the pandemic were.
Exactly. Yeah, COVID was a huge swing factor, and that's something that we track too. If we identify certain swing factors, you can have some that are positive, like maybe an unexpected win that you're bringing on new revenues and they're coming on earlier than expected, or you've had to renegotiate with some of your costs, and if they've gone up and that's not within the budget, then you have to track that. And like you said, reforecast and try to see, because you've got all the stakeholders that need to know where you're really going to end up at your end.
Yeah, absolutely. Another kind of throwing out a question to you, Stephanie, as we're thinking about, reviewing our actual performance in the P&L compared to where we had budgeted to be for the year, what are some types of things that a business might consider if revenue isn't quite coming up to where we expected? It's not quite at the budgeted amount, but you have some room and some savings within the SG&A line where you expected to spend X, but you're actually spending beneath that.
Yeah, that's a really good question. Like I said, so we track SG&A as a % of revenue. And we do break down our P&L and send out budget to actual results to each of our managers so they can look in more detail and see where they're at relative to budget. But with SG&A, it sounds like it's a good thing if it's gone down because your revenues have gone down. But there might be some things within SG&A that you needed that you didn't spend to get your revenues. So budgets are a good reminder of what your plans were. So, some of the managers might have been expecting to hire a salesperson, for example, and for whatever reason, they didn't do it in time with the budget. So they were under. And that's a reminder that we needed this salesperson. And maybe that's why our revenues are down, because we didn't have this extra person. And there's other things like that, or you don't have enough customer service folks. So maybe your service isn't as good, and so your revenues are declining as a result. So you want to make sure that you're following through on your plans and monitoring your budget for those types of things, because sounds like a win, but it might not necessarily be a win.
Right, your earnings might be coming in where you expected them to, because your expenses or your reduction in expenses is making up for the loss in sales, but that could impact you in the long term
exactly.
if your revenues continue to miss. I mentioned in the quick summary at the beginning that when there are projects that you're embarking on, specifically a new product line that you've launched, and you're trying to make sure that you can track the ROI on those projects, that a lot about that particular project can be implied within the P&L. So this particular P&L, this is a real high level. However, what you don't see here, within that revenue bucket is all, you can break that down further, and there could be multiple line items for all of the different products that the company might be selling. And it's, whenever you're launching a new product, that's a new line item that's created. So that's kind of where you can see that particular product starting to pop up and seeing the revenues coming in from there. And then it's tough sometimes with the expenses, because it looks like everything's all bulked into this one pool, right? Aggregated into this one pool. But oftentimes companies will actually have what are called cost centers, or product centers, where they're actually breaking down the expenses separately behind the scenes by product or by different departments, so that it's easy to see how this department is performing, or how this particular product is performing, all the way top to bottom.
Exactly. So, like I said, the P&L can almost be in snippets. It can be just expenses sent to a manager. It can be, a project sent to a project manager of, these were the implementation costs. This is what we budgeted. These are the revenues that are coming on board. This is how it's ramping up. This is what we budgeted. This is how the ROI is looking, so like you mentioned ROI, and you can really track anything in detail. And then it helps you tell the story too, when you roll it up, of why something might be off.
Yeah, absolutely. Well, fantastic. That was a great overview of the P&L. We're going to kick it over to Antonella now to talk us through the next of the financial statements, the balance sheet.
Okay, great. Thanks, Nicole. So a balance sheet is a financial statement that presents the balance of an entity's assets, liabilities, and equity at a specific point in time. So in order for the balance sheet to balance, the assets must equal the sum of the liabilities and the stockholder's equity, like it shows in this equation. And this is also known as the accounting equation. So liabilities and equity represent how the assets of a company are financed. Assets grow when a company is profitable, or through the issuance of debt or equity shares. So for example, when you take out a loan, the company's cash will increase by the amount of the loan. And when a company issues stock, it typically receives cash in exchange for the stock. So let's run through an example in the next slide. So this is the balance sheet of AWWC Claims Management. And this balance sheet can be broken down into a few components. So you have the heading, and then you have your assets, you have your liabilities, and you have your stockholders' equity. So because the balance sheet is a snapshot at a specific point in time, the cutoff date must always be shown in the heading. So this balance sheet shows the balance of the assets, liabilities, and equity as of December 31st, 2018. So then the assets are listed first, and they're listed in order by liquidity. And liquidity is how quickly an asset can be converted to cash. So cash is the most liquid asset, and that's always listed first in the balance sheet. And it's the most liquid because it can be used immediately to pay a liability. And assets are grouped by current assets and long-term assets, as you can see in the balance sheet here. So an asset is classified as current if it can be converted to cash within a year. So the next item that we're going to move to is the liabilities. So the liabilities are categorized similar to the assets. They're categorized as current or long-term, and they're typically listed in order by the term. So it's categorized as current if payment is due within a year. And then the last item on the balance sheet is stockholders' equity, which shows the initial amount of money invested in the business and cumulative profits after dividends. So going back and looking at this balance sheet, the statement says that as of December 31st, 2018, the balance of the assets for ABC Claims Management is $208 million. And then the balance of the total liabilities is $25 million. And then there's $183 million of stockholders' equity. Now, if you add up the liabilities and the equity, the $25 million plus the $183 million, you'll end up with $208 million. And that equals your total assets. So this balance sheet is in balance. So always remember the accounting equation. Assets must equal your liabilities plus equity. All right, so let's take a deeper dive. What is an asset? So an asset is an item of economic value owned by a company with the expectation that it will provide a future benefit. Assets include cash, investments, receivables, inventory, prepaid expenses, and physical and intellectual property. So typically, individuals like yourself will own a bank account with cash, or you might have investments in retirement accounts like an IRA or a 401k, or you might own a home or a car. These are all assets. And assets like investments, receivables, inventory, and property all hold value, and they can be converted to cash at a future date. So for example, if you own a home, you can sell it, and in this market, you get a lot of cash. So cash can be used to invest back into the business or to pay out dividends. And we'll talk more about dividends later. All right. So moving on, let's dive into accounts receivable. So accounts receivable is the balance of money owed to a company for goods or services delivered but not yet paid for by the customer. So a receivable arises from credit sales or loans. When a customer purchases goods or services on credit, they're making an agreement with the company to pay with cash on a later date. So if you notice the accounts receivable balance start to increase over time, it could mean that there has been an increase in credit sales or that there's been a delay in collections, or both. So companies track how long it takes for credit sales to convert to cash by calculating the days sales are outstanding. So that's what this equation here is on the slide. DSO, days sales are outstanding, is equal to the balance of your accounts receivable divided by your credit sales multiplied by the total number of days.
Yeah, so in this situation, credit sales doesn't necessarily mean like credit card. It's sales that you issue to a client that they don't have to pay right away, that they're going to be invoiced and they pay for at a later date.
Yep, that's right.
Yeah. As we're thinking about accounts receivable and your days sales outstanding and these different metrics that we measure as businesses, I think that this came up in the budgeting session. I forget which session, but I think it was in the budgeting session where we talked about the fact that, you know, companies want to be able to hold on to their cash for as long as they can. So how should folks that are negotiating contracts with clients think about payment terms? You know, kind of tie it all back to accounts receivable and day sales outstanding, and how should they be thinking about payment terms when they're doing those negotiations with the client?
So yeah, you definitely want to have shorter payment terms, because what you want is to have cash sooner rather than later, so that you can use the cash to pay for other things, whether they're liabilities or to invest back into the business.
Yeah, and you'll see oftentimes where a client will, or you know, you'll request to have, say it's a licensing fee. You know, as the person who's selling that product, oftentimes you want to be able to get the full value of that entire license paid up front, right? So even though I know you're going to use it for 12 months, 24 months, I want you to pay me for all of that today. And then alternately, you know, you can kind of negotiate and say, no, you can do quarterly or you can do monthly. And those quarterly and monthlies are due within 30 days. So there's a lot of different ways that we can play with payment terms that really do benefit the company at the end of the day. And you'll hear a bit more from Nicole on how that all impacts us in terms of cash flow.
Right, definitely. I mean, as a company, you always want to speed up the collections of cash and slow down the disbursement of cash.
Yeah, exactly. All right.
All right, so let's walk through an example for AWWC Claims Management. So in Q3 of 2018, AWWC Claims Management reported accounts receivable DSO of 60 days. So they wanted to improve on this in Q4. They wanted to make it align more with their payment terms of 30 days. So they decided to double down on their collection efforts. And they did this by communicating around payment terms ahead of time and following up on late payments in Q4. So at the end of Q4, the accounts receivable balance was the 1.1 million. And then the company had credit sales for the quarter of 3 million. So to calculate the days sales outstanding, the DSO, we're going to take the accounts receivable balance of 1.1 million and divide it by the net credit sales for the quarter of 3 million and multiply that by the number of days in Q4, which is 92 days. So DSO for Q4 is 34 days. So they managed to improve their DSO from 60 days to 34 days, and that's very impressive. But why is this so important? And that's because the longer sales are held up in accounts receivable, meaning the longer it takes to collect cash, the longer it takes to have the cash available to use for other things in the business.
Yeah, absolutely. You know, there are companies that have entire teams of collection specialists, and that's all they do all day is they email or call clients following up on invoices. And oftentimes, you know, in this particular example that you put here, where there was a concerted effort to actually reduce DSO, companies will actually bring somebody on, especially for a short period of time, as like a contractor or a temp worker, just to purely focus on, you know, getting the accounts receivable collected to do these, because it's worth it for the company to spend a little bit more on that person to get that cash in the door and to clean up their DSO a bit. Another thing to think about here too, as we're kind of talking about client payment terms, is that, you know, there will be multiple arrangements that you have with your different clients. There are going to be some clients that pay you upfront, like I mentioned. There are going to be some that pay you quarterly. There might be some that pay you on receipt, some that have 90-day terms. When you're putting your budget together at the beginning of the year, to the extent that that is all known, for existing clients that you haven't baked in yet, it's really important too to make sure that you're taking those different payment terms into consideration within the budget, so that you really have a good understanding of where your cash sits or where your cash will likely sit throughout the course of the year. Because if I assume in my budget, I'm going to collect everything right away, or I'm going to collect everything in 30 days, my budget is going to have a higher cash balance than our reality, because there's going to be some payments that we know are going to spread out a little bit later in the year.
All right. So far we did a brief intro to the balance sheet. We covered assets, and we covered one of the assets, which is accounts receivable. Now we're going to move on to liabilities. Liabilities are amounts owed to other parties, and they include bank loans, lines of credit, accounts payable, accrued expenses, and unearned revenue. Okay, so accounts payable is money owed to suppliers. An increase in accounts payable could indicate that the company has increased its purchases on account, or that it has delayed payments to its suppliers. When you think of a liability on the individual level, you may have a credit card or multiple credit cards. You may have a car note or a mortgage on your home. These are all considered liabilities. All right, and let's move on to the last component of the balance sheet, and that is your stockholders' equity. So sometimes referred to as net assets, equity is the remaining assets available after all liabilities have been paid. You can think of equity like you think of equity in your home. If the value of your home, which is an asset, is $750,000, and then the balance on your mortgage loan, which is a liability, is $550,000, then you have about $200,000 of equity in your home. That's the $750,000 minus the $550,000 gets you the $200,000 of equity. So it's very similar on the balance sheet. You take your assets minus your liabilities, and you get your equity. Equity includes common stock, additional paid-in capital, and retained earnings. So retained earnings is cumulative profits of a company that are not distributed as dividends. So I mentioned dividends a couple of times. Dividends are payments made out to stockholders from the profits of the business. Retained earnings are profits that are retained by the business. And these profits are reinvested into the business to either increase working capital, purchase fixed assets, or to pay off debt obligations. So I mentioned working capital, so let's talk about that. What is working capital? So working capital is your current assets minus your current liabilities, and it identifies the company's liquidity and ability to meet obligations within the ordinary operations of the business. So like we talked about earlier, your current assets are assets that can be converted to cash within a year. So that's cash, accounts receivable, inventory. And your current liabilities are liabilities that are due within a year, such as accounts payable, accrued expenses, or any short-term debt. So working capital is an indicator of the short-term financial health of the company. A positive working capital, which means that your current assets are greater than your current liabilities. If you have a positive working capital, the company is able to support its day-to-day operations. The company has enough capital to pay short-term debts and upcoming expenses. So a company with negative working capital, that's where the current liabilities are greater than the current assets. They have to rely on outside funding in order to continue operations. So with no outside funding and no profitability, a company is likely to go bankrupt. That's why it's so important to monitor your working capital.
So if your working capital is high, what are some things that a company might consider doing?
So if your working capital is high, you might want to, well, there's different examples. So maybe you can expand, you can buy property. Maybe you can invest in your sales team so that you can expand across to new territories and increase your sales. You can pay out dividends to shareholders. There's many different things that you can do, and usually companies will align with whatever it is that their vision or goals are.
And is a low working capital always a bad thing?
Not necessarily. It could be a bad thing if you don't have outside funding, but if you're like a startup company, you might have low working capital, but you have funding from your investors. So it's expected, and you have plans to increase sales over time and build on working capital, then I'd say it's okay to have the low working capital.
Awesome. All right, thanks, Antonella. So we're going to bring Nicole up now to talk us through cash flow statements to wrap us up for the morning.
Okay, so the cash flow statement, what is this? We know that our net, is it the same as our net income? Is it the same thing as, looking at the balance sheet? So the P&L that Stephanie presented has non-cash transactions in it. The P&L is measuring the expenses that it takes to generate the revenue for that specific period that we're looking at. So when we're looking at the cash flow, we're actually trying to take out those accrual type of accounts and move that into what is our cash. So can you actually have net income, but yet not have enough cash to pay your bills? Yes. And can you actually have like a net loss, but you still have cash to carry you through? Yes, definitely. So some of the examples that we looked at, like with the P&L, were like the accounts receivable versus the revenue, accounts payable, which could be like a telephone expense. You have accumulated depreciation expense, which shows up on the P&L, and we have to actually subtract that out. So what is the cash flow statement? So the cash flow statement, it's a financial statement that shows how the changes on the balance sheet for the current assets and the current liabilities, how it affects your cash and cash equivalents. So the cash flow statement measures how well a company is actually managing its cash position. It does this by actually looking at three different categories: the operating activities, the investing activities, and the finance activities. So we're going to look at the operating activities first. When we look at the operating activities, this is your actual day-to-day service or the product that you're selling. So this is, where we have like the accounts receivables section. So you take your net income, and if there's like on your accounts receivable on the balance sheet, that would, if that actually like decreased, then we know that we're actually receiving cash because your receivables on the balance sheet has now, lowered. Now, if it increases, that means that our customers aren't paying us in time, and therefore there's an actual decrease in cash. We don't have that money to spend. The same thing with accounts payables. If you have a higher accounts payable, that means we're actually holding on to our cash. As our accounts payable or liability accounts, those decrease, then we actually get the ability to, actually we're paying out cash, so we have less cash to go through. So now when you're looking at the cash flow from the investing activities, those are components that actually would have, are you selling a building? The outflow of cash, or that would be the inflow of cash. Outflow of cash would be an example of we're actually going to be purchasing computers, or we're investing into putting into a new computer system or products. So when we're actually doing the investment, as there's an outlay, it doesn't matter that it's a negative amount. That means that the company's actually reinvesting into the company itself. So now we'll go to the financing activities. Sorry about that.
Not my bad.
So the financing activities, a lot of people get that confused with investments. And so as Antonella was talking about, when you're looking to like expand your company, we're looking ways to raise capital basically. Are we going to go out and get a loan from a bank? Or are we going to actually just have equity through selling stock? So that's where the financing piece comes in under that section of the cash flow statement. The investment activity is when you're actually putting money into like capital expenditures. So the inflow of cash, for an example, would be we actually sold stock. So we received money and we had actually sold pieces of our company to other people. Or you could actually go out and get a loan from a bank. And if you get a loan from a bank, then you're actually receiving the cash that comes in. So that's how you're going to decide how you want to finance the, the new product or the new service that you're going to go into or expand your company. The point of the finance activities to show the outflow is actually paying dividends, or if when you start having to pay back the loan. So if you're actually looking to invest into a company, a good point to look at on a cash flow statement is, do they actually pay the dividends? Because you want to know if you'll be able to receive that. So the next slide we have is we actually show a cash flow statement. You always start off with your P&L from the net income, or here we actually had a net loss. So this is showing that while we even had a net loss, you go through these steps in the operating portion. You add back like your depreciation because you're not receiving cash for depreciation. We had a decrease in accounts receivable, which means we actually received cash. So that's an inflow. You have an increase in accounts payables, or if you have a decrease in your taxes payables, sorry, that would show the outflow. And if you look to the right part of the screen, the net cash from operations is 1.6. which actually means you had more cash flow, and it according to not having the net loss. So we still are actually having cash. When you go to the second section under the investing, you can see that we spent like $4,000 on equipment, which means, I said 4,000, I mean 4 million, sorry. This is supposed to be where, we're investing into our computers and, putting into a new system. That's great because that's showing that the company's investing and that we're here for the long term. Now, when you go to the bottom of the cash flow statement, the cash flow from financing shows that dividends were paid out so that we spent cash left the company. And we actually have a $10 million loan coming in. So that means that we've actually are looking to expand our company. So when you look through the differences of those, the finance flow of cash was actually $5 million. So when you take all those into consideration, the cash flow for the year end was 2.6. The way you balance this out is you take your cash and your cash equivalents from the beginning of the period, less the ending of the period, and those two should match. And that gives you the ability to see, is your cash flow coming from operations? Are we making, a profit there? Or is it actually coming from the fact that we had to go out and look for other resources through financing? Or are we spending money through the investments? So you have to use all three of these actual statements together to understand where your company is, or what company you're actually maybe going to do business with, or, if you want to invest into a company yourself. So I was going to say, did you have any questions, Nicole?
Yeah, I was going to say, although we all know that cash is a good thing, right? So increasing your cash must always mean, the company, the health of the company is solid. Is that correct?
Yes, definitely. Well, the thing with the cash flow statement is you can look at it two ways. If you are actually expending your cash at this point, it could be a good thing because you're actually, going to be growing, and you have to spend money to make money,
Yeah.
So
no, I was going to say, we always think about, cash is high, the business must be very healthy. But there are actual times, and it popped up in the other two sections as well, with both Stephanie and Antonella, where having extra working capital or extra cash on hand might also indicate that the business isn't making great decisions in terms of reinvesting into the business for future growth.
Exactly. That comes to a point of, are you keeping up with, technology? So you want to see that a company is spending and, investing into the service and products itself, and moving forward with it too.
Yeah, and on that note, so we've, within the other sessions where we talked about, project roadmaps and prioritization, how can a company's cash flows, or understanding a company's cash flows, help in making decisions about launching a new product or developing a new product or doing some sort of a project that requires a financial investment?
I think that the different ways to look at it is, first of all, is the operations piece, generating cash. And if it's not, and you need to make fixes there, maybe you need to invest into better equipment, if that's the project that you're looking into doing. Or, maybe we do have financing that we can now go and expand. So you have to look at, again, all three of the statements together and, figure out exactly what the goal is and how you're actually progressing and what the return on the investment would be.
Yeah, exactly. If we know that our cash flows are kind of hurting a little bit, and the particular project that we're thinking about doing is one that is going to have a really long tail in terms of being able to get our return on investment, and it's going to take a lot of investment and a lot of effort, it might be something that we push pause on for a little bit. Whereas if it's something that we know we'll get a little bit more of an immediate return on our investment and there's a more immediate cash inflow, that might be a great thing for us to embark upon.
Oh, exactly. Especially, look at what we just went through with COVID.
Yeah.
This was a time that people had to look at all three of their statements and make a decision. Are we able to still, function and keep where we're at and move forward with our projects, or do we put those on hold? And what is the effect of that?
Yeah, absolutely. Absolutely. Well, we are just about up to the hour here, so that's going to wrap it up for us today. Thank you so much to Stephanie, Antonella, and Nicole for sharing your expertise with us today. And a big thanks to everyone for listening in. If there's anything you missed, there will be a recording of this session along with the last three sessions, all available on the AWWC website. So that's it for us today. Thank you so much. Enjoy the rest of your day.